Welcome back, everyone, to the Deep Dive. This time we're taking a deep dive into the world of corporate finance. Specifically, we're going to be exploring a study that's kind of turning a fundamental theory on its head.
Yeah.
The pecking order theory.
Right.
Now, you've probably heard of this idea.
Yeah.
It's the basic idea that companies prefer to use, their own internal funds first.
Mm-hmm.
Then they would prefer debt.
Yep.
And then finally, and only as a last resort if they absolutely have to, they'll issue equity.
Well, at least they have to.
But what we have today is some research that suggests that things might not be quite so straightforward.
That's right, yeah. This study looked at a very large data set of publicly traded companies.
Oh, wow.
In America. And this was all the way from 1971 to 1998.
Okay.
So they're really trying to test one of the core predictions of the pecking order theory.
Okay.
And that is that when a company needs money, which we call a financing deficit, that this should be matched dollar for dollar by an increase in their debt.
Okay, so like if a company needs $1 million, they'll just go out and borrow $1 million.
That's exactly what the theory would predict, yes.
It seems like that fits the theory, right? They don't want to issue equity, so they'll turn to debt to cover their needs.
Yeah, that's right. However, the study found something pretty surprising. They found that net equity issues actually tracked financing deficits more closely than net debt issues.
Hold on. So does that mean that companies aren't actually, shunning equity as much as we previously thought?
It definitely raises some questions, yeah. So now remember that the pecking order theory, it's really rooted in this idea of information asymmetry.
Yeah.
The companies know more about their own prospects than outside investors do. And this can lead to all sorts of worries about things like adverse selection.
Right, like the whole used car problem we've talked about before.
Exactly, yeah. Investors are always worried that they're going to get a lemon. Yeah.
So the idea is that companies should prefer to use debt because with debt you have a fixed repayment schedule.
Right.
Investors feel a bit more secure. But this study kind of challenges that assumption.
Okay.
It suggests that maybe equity isn't the kind of dreaded last resort that we've always thought it was.
So if companies are only relying on debt to fill their financing gaps.
What about internal funds? I thought that was supposed to be like the number one go-to.
Well, the study looked at that as well, and they found that especially in periods of really rapid growth, like we saw, for example, in the 80s and 90s, internal financing just wasn't enough to actually cover the investments that companies needed to make.
So they had to go external.
They had to rely heavily on external financing.
Interesting.
And that's where equity played a bigger role than the pecking order theory would suggest.
Wow, this is really, really interesting. So are there any companies that actually do follow the pecking order?
It's not totally a myth.
Okay.
But it's definitely not as universally applicable as we might have thought.
Okay.
One really interesting thing that they found is that the pecking order theory, it seemed to hold more weight among larger firms.
Oh, okay.
Especially, back in the 70s and 80s.
Okay, so size matters.
It seems like it, yeah.
But wouldn't you think that larger companies would have more options?
You'd think so.
And be less constrained by something like the pecking order theory?
Yeah.
I mean, larger companies tend to have more established reputations, more transparent financials.
They're less of a mystery to investors.
So less of that, used car anxiety.
Yeah.
But if that's the case, why would they stick to the pecking order more closely than smaller firms?
That's a really good question. And it's one of the really kind of big questions that this study raises.
Yeah.
It suggests that there might be other things going on beyond just information asymmetry. Yeah. Maybe larger firms have different risk tolerances. Or maybe they're more sensitive to the signaling effects that their financing decisions might have on the market.
I see, yeah. So what about other factors that traditionally explain how much debt a company uses, like how profitable they are, or what kinds of assets they have?
Exactly.
Did the study look at those kinds of things too?
Oh, absolutely. They included those factors in the analysis.
Okay.
And they found that financing deficits still mattered, but not to the extent that the pecking order predicted.
Okay.
And so what that's telling us is that companies are looking at multiple factors when they're making financing decisions.
Interesting.
It's not just information costs.
So it's not just as simple as, we need money, let's go get debt.
It's more complicated.
It sounds like it. It sounds like companies are playing a much more complex game than the pecking order suggests. Before we throw out this whole theory, Did this study offer up any other explanations for how companies actually do decide between debt and equity?
Well, not exactly. I mean, this research was really more about challenging existing assumptions than proposing like a whole brand new model.
Okay.
But it definitely, it opens the door for future research.
Yeah.
And more exploration on this topic.
Very interesting. Okay, so it really sounds like we're seeing some serious cracks in this pecking order armor.
Yeah.
It's not as ironclad as we once thought.
That's right.
But it doesn't mean that we should completely throw it out, right?
No, I wouldn't say that. I think that while this study really challenges like how universal the pecking order theory is, it doesn't completely invalidate it. I mean, it's still a pretty useful framework for understanding some aspects of financing behavior.
Right.
But yeah, clearly there's more to this story.
There's more to it. So what stands out to you from all of this?
I think for me, the big takeaway is that companies are adaptable. They don't just blindly follow a single rule book.
Right.
They respond to market conditions, their own kind of internal circumstances, and a whole bunch of factors that are honestly probably kind of difficult to measure.
It makes sense. It's not like a one-size-fits-all approach to finance.
Right.
Each company has its own story
Absolutely.
and its own priorities. We've been talking about, the U.S. market here, but it makes you wonder about other places.
You're thinking globally.
Globally.
Yeah.
Different countries, different cultures, different market structures. Could those influence financing decisions in ways that, like, maybe the pecking order doesn't capture?
Yeah, I mean, that's a really fascinating question. Just think about it, like cultural attitudes toward debt versus equity. Those can vary widely.
Absolutely.
And you also, some countries that have, regulatory environments that might favor certain financing methods over others.
It's a whole world of possibilities.
Yeah, it really is.
A global pecking order adventure. But on a more practical level, though, these findings do have real-world implications for people, right?
Oh, absolutely.
Like our listeners.
Yeah, I mean, if the pecking order theory is not as, set in stone as we thought it was, it could change how we value companies or what kind of investment strategies we use.
It could literally change how we think about investing and analyzing companies.
Exactly, yeah. So, for instance, we might be used to seeing equity issuance as a negative signal.
Right.
Like, oh no, the company's in trouble.
Yeah.
But we might actually miss out on opportunities where companies are, strategically using equity to actually fuel their growth.
Right. Or we might just totally overestimate how risky a company is if they're relying a lot on equity financing.
It's a good point. Yeah.
So it seems like we really need to be careful about applying like a one-size-fits-all approach here.
Yeah, I think we do.
We need to look beyond just like the simple rules of thumb.
Right.
And think about the context for each company.
Absolutely.
And like, how are they making their financing choices?
Yeah, exactly.
So what does this all mean for our listener?
Yeah.
What should they take away from all of this?
I think probably the most important message here is to just be a critical thinker.
Yeah.
About everything you thought you knew about corporate finance.
Right.
Don't just accept, the textbook explanations at face value. Dig a little deeper.
Question your assumptions.
Exactly. Be open to new ideas.
Absolutely. Because the world of finance is constantly changing.
It is.
So we need to stay curious and we need to stay adaptable.
I agree.
If we want to make smart decisions.
Yeah.
So it's like we've been given this whole new way to look at the financial world.
Yeah, for sure.
And this is just the U.S., right?
Exactly. I mean, this study only focused on American companies.
What about everyone else?
I know, right? There's so much more to consider. I mean, when you start to think about cultural differences and, the different rules in different countries and how, markets are structured differently around the world.
I mean, could those things actually influence
absolutely.
these financing decisions in ways that we haven't even thought of?
Yeah. I mean, think about it. You could have countries with the pecking order is totally flipped.
Oh, wow.
Where, like, companies would rather issue equity than debt.
I never thought about that.
Yeah. I mean, you could have places where investors are really well protected. Or maybe there's a culture that's just more open to taking risks.
It really changes things up.
Yeah, it really does. It opens a lot of doors.
Yeah.
For, future research and exploration.
And I'd love to do a global deep dive someday.
Oh, me too. That'd be fascinating.
Yeah, to go all around the world and kind of figure out all these different financial patterns. But even without, like, hopping on a plane.
Yeah.
I mean, we can start to see how all of this impacts people.
Oh, for sure.
Right here, right now.
Absolutely.
Our listener, for example. How can they use all this information to maybe make better investment decisions?
Yeah, I mean, I think it's just a good reminder not to jump to conclusions. Right. If a company issues equity, it doesn't automatically mean that they're in trouble.
Yeah.
There might be some really strategic reasons for it.
Okay.
It's not necessarily a bad thing.
So instead of getting scared, we should actually try to, do some digging.
Exactly.
And figure out why they're doing it.
Yeah, what are their motivations? What's going on in the market?
Yeah.
That might be influencing their decision.
Okay.
And
then on the flip side of that, even if a company is following the pecking order, they're using a ton of debt.
Right.
It doesn't necessarily mean
it's a safe investment.
It's not a guarantee.
Yeah.
You still have to look at their financials. Can they actually handle all that debt?
Right. It's all about context.
It really is.
It sounds like the pecking order, Yeah. It's a good place to start.
Yeah.
But we have to remember that it's not everything.
Right. There's a lot more to it.
We need to think about all these other factors.
Absolutely.
That might be influencing the financing choices.
Yeah.
We really need to be critical thinkers here.
We do.
And not just, follow the rules.
That's a good point.
Blindly.
Yeah. And I think that's one of the things I love about finance.
Yeah.
There's always more to learn. There's always something new to discover.
Absolutely.
And there's always something out there that can challenge what you thought you knew.
Absolutely. Well, this has been an amazing deep dive.
It is.
Into this whole idea of the pecking order theory.
I feel like we've challenged, what people think. We've seen some really surprising findings.
For sure.
And hopefully we've kind of, lit a fire under our listeners.
I hope so. To
go out there and learn more.
Yeah.
So thanks for joining us on this journey.
It's been a pleasure.
And remember, the next time you're looking at a company, maybe you're thinking about making an investment.
Right.
Don't just rely on the textbooks.
No.
Think critically.
Yes.
Question everything.
Question assumptions.
And be open to those new perspectives.
Absolutely.
Until next time, keep exploring.
Keep learning.
And we'll see you on the deep dive.